Closing a business? It's a big decision filled with a mix of emotions. You've poured your heart and soul into building something you're proud of, but now it's time for a new chapter. But before you start celebrating, listen up. There's one crucial thing you can't afford to ignore: your taxes. That's right, the IRS wants its share. And believe me, it's not the time for surprises. In this video, we're going to arm you with the knowledge you need to navigate the tax implications of shutting down your sole proprietorship and keep more of your hard-earned money in your pocket. Let's talk about your business assets, the equipment, the inventory, maybe even that trusty old coffee maker that's seen it all. When you sell these assets, the IRS sees it as generating either a gain or a loss. Now, how you allocate the sale price to each asset can make a world of difference come tax time. You see, different assets have different tax rates. Some might qualify for capital gains treatment, while others might be taxed as ordinary income. And trust me, you want to pay the lowest possible rate on those profits. We'll delve into the specifics so you can strategize and keep more of your hard-earned money. Here's the deal. When you sell a business asset for more than its adjusted basis, that's the original cost minus any depreciation, you've got yourself a taxable gain. But if you sell it for less, congratulations, you have a deductible loss. Now, this is where things get interesting because the character of that gain or loss, whether it's ordinary or capital, depends on the type of asset. Capital gains, especially long-term ones, are taxed at a lower rate, which is music to our ears. We'll break down the different asset classes and their tax implications, so you're not caught off guard. Now let's talk about depreciable real estate, the backbone of many businesses. The IRS has special rules for this one, particularly sections 1250 and 1231 of the tax code. Section 1250 deals with depreciation recapture, which can sting a little if you're not careful. Essentially, it means that some of the depreciation you claimed over the years might be recaptured as ordinary income. Section 1231, on the other hand, can be your friend, potentially allowing for capital gains treatment on certain real estate sales. We'll unravel the complexities of these sections so you can make informed decisions about your property. Beyond real estate, there's a whole world of depreciable or amortizable assets. Think vehicles, equipment, even patents or copyrights. The rules for these assets are similar to those for real estate, but with their own nuances. Depreciation recapture rears its head again, potentially turning some of your gains into ordinary income. Don't worry, we'll guide you through it all step by step, so you can understand the tax consequences and plan accordingly. Remember, knowledge is power when it comes to taxes. Now let's say you're selling your business and the buyer wants you to sign a non-compete agreement, essentially promising not to open a competing business down the street. Believe it or not, the IRS has something to say about that too. Payments you receive under a non-compete agreement are considered ordinary income. That's right, just like wages. We'll explore the ins and outs of these agreements so you understand the tax implications and can negotiate accordingly. Now for the good stuff strategies to minimize your tax liability. Remember, it's not about avoiding taxes altogether. It's about paying what you legally owe and not a penny more. One strategy is to time the sale of your assets strategically. Long-term capital gains rates are generally lower than ordinary income tax rates, so holding on to assets for longer than a year can save you money. Another strategy is to offset gains with losses. If you have other investments that have lost value, selling them in the same tax year can offset your business asset sale gains. We'll dive into these strategies and more, so you can keep more of your hard-earned money in your pocket. Okay, so you've sold your business assets, you've strategized to minimize your taxes. What's next? Well, it's time to report those gains and losses to the IRS. Don't worry, it's not as daunting as it sounds. We'll walk you through the necessary forms, primarily Form 4797 for asset sales and Schedule D for capital gains and losses. We'll also cover the key information you'll need to gather and the deadlines you need to meet. Remember, accurate and timely filing is crucial to avoid penalties and keep the IRS happy. Hold on a second, we're not quite done yet. While we've been focusing on federal income tax, don't forget about your state income tax obligations. Each state has its own set of rules, and some states have capital gains tax rates that differ from their ordinary income tax rates. We'll provide an overview of state tax considerations and point you to resources where you can find specific information for your state. Remember, staying informed is key to avoiding surprises down the road. Closing a business is a significant step, and understanding the tax implications is crucial for a smooth transition. By following the guidance in this video, you've taken a proactive approach to protecting your financial well-being. Remember, knowledge is power, and with the right information, you can navigate the tax maze with confidence. So, as you embark on this new chapter, do so with your head held high, your finances in order, and the excitement of what's to come.